going to be recorded. You will all be getting a copy of the slides as well as a link to the recording. So you've all been invited here because you have a self-funded or a level-funded health plan. Anybody who doesn't have a plan like that didn't get invited in the first place. So you are in the right place. I'm going to be joined today by Jeff. Jeff is our Assistant Vice President of Account Management. He is my benefits go-to, so he will be helping us out and jumping in and helping to explain some of the more technical aspects of what's required of you with a self-funded plan. So
for sure. Good morning, everybody.
I want to encourage all of you to also unmute if you have a question. You can also type any questions into the chat. Jeff's going to be monitoring that, but we try to make this as casual as we can. So if at any point you do have a question, feel free to unmute yourself and go ahead and ask it, because chances are if you have a question, there are probably other people out there with a similar question. So we do encourage you to do that. So what we're going to cover today, we are going to go over very basically what's meant by a self-funded plan. I know that some of you might be new to a self-funded plan. Others of you, this is going to just be a refresher of what you need to do. We're going to go over what your reporting requirements are with this type of a plan, and also what kinds of notices you need to be sending out to your employees. Again, this is for informational purposes only. I am not an attorney. I am not a tax advisor. You will see as we go through this that a lot of this dips into IRS territory with filings. So I'm telling you what's required, but if there are any really specific questions about what forms need to be done, how to fill them out, those are things that a tax advisor will be able to help you out with. Regarding what's actually a self-funded health plan. So all of you offer a plan. If you offered a fully funded plan, it would be kind of that traditional plan where all of the claims go to the insurance company makes all the decisions. You are paying a per head fee whenever you add somebody onto your plan. It's a set amount that you're paying for that person to be on the plan. The insurance company's taking care of the rest. When you're self-funded, there are two different kinds of self-funded plans. There's a traditional self-funded plan, and then there's also what's called a level funded plan. So for those of you who are in the Blue Edge business plan, that's level funded. I want to make this differentiation that a level funded is a form of a self-funded plan, because sometimes our clients are saying, well, we're not self-funded, we're level funded. If you are level funded, you are also self-funded. That is a type of a self-funded plan. So in these plans, you likely have a third-party administrator who is basically processing the claims for you, but you're paying for those claims directly. Generally, it's out of your general assets. Some companies have a specific fund set aside that you pay the claims out of. So you're actually paying the claims as they come in. Jeff, do you have anything to add to that?
Yeah, for sure. So generally when I'm discussing what a fully insured and a self-insured plan is, I always like to indicate that that level funding kind of falls right between your fully insured and your self-insured. It's almost a hybrid, because you're getting the benefits of that set premium every single month. You're also getting the benefits of that self-insured option where it can generate a surplus, and you have access to see how the plan is actually running. You see how your claims are running. And for those of you that are smaller employers, you do have the option of enrolling in a level funded plan if you do qualify. Typically, you'll see that fully self-insured option for more larger employers, over 100 or several hundred employees.
Okay, thanks.
I have a question.
Yeah.
So isn't typically with self-funded plans too? Like, I know this Blue Edge plan doesn't follow those guidelines, but sometimes self-funded plans don't necessarily follow the state guidelines. So like, for example, mammograms are typically covered at 100%, but under some self-funded plans, they don't have to follow state guidelines.
That's accurate. That's absolutely true. It's 100% true. So on some fully self-insured plans, they do not cover the actual state guidelines, and you do have the option of an employer what to cover and what not to cover. So that's a good point.
Okay. So regarding non-discrimination, anybody who has what's called a Section 125 plan, meaning your employees are paying their portion of their premium on a pre-tax basis. You're familiar with the fact that the plan cannot be discriminatory. So you can't have your highly compensated employees being favored in any terms of the plan over your lesser compensated employees. And if you have a self-funded plan, you have to follow what's called Section 105, which is just a little bit more restrictive. It has a little bit more of a restrictive definition of what a highly compensated individual is. So that defines your highly compensated employee. Instead of officers or 5% or more owners or anybody making more than 130,000, it's defined as your 5 highest paid officers, anybody that's more than 10% of a shareholder, and your highest paid 25% of employees. So what this basically means is that when you do non-discrimination testing to see if make sure that your plan is not discriminatory, it's going to be a little bit harder to pass under a self-funded plan than it would be under a fully funded plan. Hopefully you're going to pass anyway, but it is just a little bit more restrictive. With a Section 125 plan, there is kind of a workaround to that highly compensated employee that you can actually exclude them from your testing by paying the full premium. But that doesn't exist in your Section 105 plan. Your Section 105 also prohibits discrimination based on age, based on years of service. So a little bit more restrictive, but hopefully the way that you've set your plans up, you wouldn't be discriminatory in either case. There is what's called a notice of privacy practices that all employees should be receiving. And it basically talks about how you're going to handle any kind of private health information. For a fully funded plan, the participants the insurer generally sends that out to the participants. The idea being that in a fully funded plan, it's your plan, it's your Blue Cross, they're the representatives, they're the ones that are actually looking at the claims. With a self-funded plan, you are more likely to be seeing the claims, who your employee usage, who's using your plan. So you're going to be responsible for sending out a notice of privacy practices. And there are some additional practices that might need to be defined that are outside of this model notice. You'll see on the bottom, I'm giving you a link to a Department of Labor model notice of privacy practices. And you can use that as your notice to your employees. If you get onto that link, it's kind of a booklet, and it will have italicized every section that you need to customize to fit your own particular plan. NFP is going to be coming out with a toolkit regarding privacy practices and the notification that you need to be giving to your employees. So anything over and above this model notice, stay tuned. There will be a toolkit forthcoming, likely in the next couple of months. But to get you started, if you are not giving out this notice of privacy practices, I would suggest that you get online, download it, customize it, and distribute it to your employees. That's one of those notices as well that we go over during open enrollment. When we do our required notices, we tell all of our self-funded clients at that point that should go out as part of your open enrollment. But if you missed it, better to get it out now than to not get it out at all. Then we have what's called a PCORI fee. That's the Patient-Centered Outcomes Research Institute. I'm not really clear exactly what this fee goes towards, but it has something to do with researching health plan coverage. It's an IRS form. So again, we're dipping our toes into that tax area. But it applies to HRAs, it applies to self-funded medical plans. And you report this and you pay this. The current fee is $3 per covered life. So it's not a whole lot of money. And you need to be filing an IRS form 720. And that form is due to the IRS by July 31st of the following year. So anybody who had a self-funded plan in 2022, you need to complete this by July 31st for the 2022 plan. Anyone who is new to a self-funded plan in 2023, it's not going to be due until next July. So July of 2024 is when you would be paying that PCORI fee. Anyone who was fully funded prior to this, you wouldn't have heard of this because the insurer takes care of that on your behalf.
Yeah, and keep in mind, there is a toolkit coming out. Generally, this comes out in May because these fees are due by the end of July. So keep your eye out for that. And if you have any questions regarding where to get the count or how to get the count of employees, please reach out to your account executive.
Thanks. When you're self-funded, you should have processes set up for appealing for employees who want to appeal their claims. When you were a fully insured plan, the final determination is always made by the carrier. So again, you as the employer probably don't get involved, but when you're self-funded, it may involve you. Most of you are contracting out to a third-party administrator, and they will generally be taking care of all of that for you. That's what you're paying them to do. But ultimately, it is still the responsibility of the employer. Even though a third party is managing this for you, the ultimate responsibility does lie with the employer. And your best practice is in your plan documents to make sure that you've got your claims procedures in there, and to set up an appeals committee, because if anything does come to you as an employer that you need to be making a decision on, you want to be ready to do that. Jeff, do you have anything to add on that one?
No, nail on the head.
Okay. Your Form 5500. Most of you are probably familiar with a 5500 filing for your retirement plan, but there is also a Form 5500 requirement for a health plan. It applies to any health plan with more than 100 participants. So if you are working for, if your employer has 100 participants in the plan, even if they're fully insured, they need to be filing a Form 5500. But if you have fewer than 100 participants and you are self-funded, this is going to be a requirement for you. And as part of that 5500 filing, most employers will have a third party do that, and they will also make a summary annual report for you. And the summary annual report is what you need to be giving out to your participants. So the thought is that the IRS is saying, nobody's going to be able to understand what a 5500 is because it's an IRS filing, it's a tax filing, it's kind of complicated, but you should have a summary annual report that's written in plain enough language for your participants to be able to see. You're also subject to that if you're subject to what's called an M1 filing. I'm not going to get into that. That has to do with if you have different affiliates. Am I right on that, Jeff? I'm really not familiar with an M1 filing.
Yeah, and if you're paying claims out of a separate bank account that is not considered general assets, but we would also advise you to seek outside counsel if that's, or your tax consultant or your accountant.
Okay. So just bear in mind that this is a requirement for you if you have fewer than 100 participants in your plan. You can always talk to your account executive as well. We can give some recommendations if you want to outsource that. Then we have the ACA requirements, the Affordable Care Act requirements. And this, again, is done by you as the employer. This isn't something that your third-party administrator does. It's not something that we do as your broker. I won't get into the details of what the difference is between section 6055 and 6056, but I've given this chart here so you can see what it is that which forms it is that you need to be completing. So
Yeah.
if you
Susan,
are
I'll jump in
small-
for a second, if you
Yeah,
don't
go
mind,
ahead.
sorry. So with these, generally, if you're a larger employer, if you're over 50, these should not be such a shock to you. But those of you that are under 50, joining a level funded plan for the first time, this may be brand new to you and a bit confusing. So what we advise is to reach out to whoever your payroll provider is. Typically, they provide a service that can assist you filling out these forms for the first time. And again, like I said, they can be confusing. You certainly can do these in-house by yourself, but they can get cumbersome and take up a lot of your time. We also do send out a toolkit regarding this with a lot of information behind what each form is, how to fill them out, instructions, and kind of an FAQ to assist you. If you do have questions, you can certainly speak to your account executive. But like Susan said, this is not a service that we provide in-house here at NFP. However, we can kind of walk you through it and help you and hook you up with a vendor that can assist you to fill these out, okay?
Right. If you only have a handful of employees, it's really not that big of a deal to do it yourself. It just looks a little bit daunting, but there are very, very specific instructions on these forms, and the instructions will walk you through exactly what information that the forms are looking for. So those of you who had a plan last year that was self-funded, you are probably in the process of doing this now, this year. Those of you who are new to a self-funded plan in 2023, this isn't going to kick in until next year, okay? But there are some things that you can do to get prepared for this, as Jeff mentioned. So, first and foremost, let me go back a minute, because you can see that there is a threshold here of 50 or more employees, and that will determine which form that you need to fill out. So the first thing that you're going to do is you need to determine whether or not you're considered an ALE, an applicable large employer, which is 50 or more FTEs. If it's really clear to you that you're under 50, you don't need to make that determination. You just know it. But we do have some clients, and they may be some of you who are hovering right around 50 employees. You're not really sure, am I considered an ALE? Am I not considered an ALE? Xywave, which is the HR database that you all have access to. If anyone has not been on to Xywave and you want to get on Xywave, let me know. I will send you another invitation to set up your portal. Xywave has a resource on there. If you just type into the search and say ALE status, there's a spreadsheet that's going to pop up that you can actually just fill out. And it includes payroll information, hours worked information, and then that will help you to determine whether or not you meet that definition of an ALE. So NFP also has an ACA reporting toolkit. It was sent out to all of our clients, but we all know that in the course of a day, when you get a bazillion emails in your inbox, that sometimes they get overlooked. So if you don't remember seeing it and you want to take a look at it, ask your NFP account exec. They would be happy to resend it to you. It's really, really helpful. So in addition to that, once you've determined whether or not you're an ALE, if you're new to a self-funded plan, my suggestion would be, even though you don't have to file these forms until next year, take a look at them now so that you can see what kinds of information that you're going to need to report on. And you can make sure that you're tracking that information in your payroll system so that it will make it easier come January, February of 2024 to actually go back and get that information out of your payroll system. Again, as Jeff mentioned, check with your payroll provider, because sometimes they will do it for you. There's usually an extra fee involved, but it might be well worth it. Sometimes they'll do it for you. At the very least, they might be able to help you to create a custom report that's going to give you all of the information that you need to transfer onto those 1094 and 1095 forms if you decide to do them yourself. So again, my recommendation would be, if you're not familiar with these forms, even though you don't have to do them until next year, if this is a new plan in 2023, take a look at it now, familiarize yourself so that it'll make it a lot easier next year when it is your time to be filing these. The deadlines on these, on the 1095B and the 1095C is January 31st. The IRS filing is February 28th, or it's March 31st if you're filing electronically. I always find I've never actually filed these, but anytime they say file electronically, it's just so much easier. And you get a little bit of extra time too. So if you had a self-funded plan in 2022 and you haven't done this yet, the deadline for giving it to your employees has already passed. Hopefully everyone's done that. And then the deadline for actually uploading the summary information to the IRS is coming up if you're going to do it electronically. So I'm going to hand it over to Jeff here, because as he mentioned, if you have a level funded plan, that you will be getting a check for the surplus. So Jeff, go ahead and talk about this.
Thanks, Susan. So as discussed before, if you've been on a level funded plan in prior years, this should not be new to you. If you are new to a level funded plan, obviously one of the benefits of being on a level funded plan is the ability to earn a surplus if your payments exceed the claims paid. On the BEB option, which is the Blue Cross Blue Shield option, it will either be in the form of an ACH or a physical check, or if you're with Cigna, it'll be a credit on your invoice the following plan year. You can change the slides now, Susan.
Okay.
So one of the assumptions employers have had in the past is that they can use this surplus at their discretion. That is not the case, assuming that employees contribute to the premium. This surplus is actually considered a plan asset. Use of this surplus should be defined in your plan document. And I know that term has kind of been thrown around a lot this morning, your plan document, your ERISA wrap plan document. If you do not have one, please reach out to your account executive. We can certainly assist in getting that set in place for you. If it's not defined in your plan document what to use the surplus for, we do advise that you use a distribution method that's reasonable, such as a premium holiday, a benefit enhancement, which means you could buy another product, an ancillary line, a voluntary line, things like that, or a refund direct to employees. Keep in mind that this refund direct to employees can become taxable income. And if you are, and I've seen this in the past, some employers have actually generated physical checks to refund their employees. That's actually becomes a taxable income on these employees. And it's also a cost to you as an employer. The most common I've seen is a premium holiday. And again, if you are not clear of what to do and how to do this, please consult legal counsel. And your account executive could also be of assistance as well.
Okay, thanks.
Sure.
So I wanted to include the penalties because this is what usually hits home. Because you might feel like, oh, I got to do all these things. Well, what happens if I don't do them? You can see it can get kind of pricey. So if you don't do your 1094 and 1095 distribution and reporting, the fine on that would be up to $290 per return. Your Form 5500 filing this is a big one, up to $25.86 per day. Your summary annual report distribution up to $110 per day per participant. Your PCORI fee, then that would be considered a late tax payment. So the IRS would start going after you for late tax filing penalties. So again, remember that compliance with all of these things, even if you have a third-party vendor taking care of it for you, that it is ultimately your responsibility because you are the plan sponsor. So for example, if you have a third party filing a Form 5500, they're going to give it back to you to sign off on. If you don't pay attention to that and forget to sign off on it and it doesn't get filed, it's your fault. So Make sure you're working closely with your third-party administrators so that you're understanding what it is that they're asking you to sign off on, you're understanding what the forms say, because ultimately it's your responsibility that they're done correctly and on time. So NFP does offer a pretty good amount of resources to help you with these things. We have toolkits that come out on a regular basis. We have that ACA reporting toolkit that came out earlier in the year. Again, talk to your account executive. If you don't remember seeing it or you can't remember what you did with it, it is really helpful. We also have a non-discrimination toolkit. There's a separate toolkit about filing your 5500. And there is a separate toolkit for paying your PCORI fee that walks you through how to do that. And it will give you some information on filling out that tax form. So I wanted to just make you aware of who your NFP account team is. You probably have been working with them, but there have been a couple of recent changes. Jeff didn't have a headshot, but we figured that you'd be looking at him anyway through this whole presentation. So
You get the live version. Lucky you.
that's right. You get the live Jeff headshot. But I always find it's helpful to put a face with a name. So here is our NFP account team. Please feel free to reach out to whoever your account representative is when you have questions on these things. They can point you in the right direction of some really good resources. They'll point you in the direction of the toolkits. They might be able to give you some guidance on it. So by all means, feel free to reach out to them. They're here to help. So do we have any questions?
Yeah, I have a question. The PCORI, if we can just go back on that one, the PCORI tax. I know I did that last year, and I know looking through it was a little bit confusing because it's annual, but looking at it, you would have thought it was quarter to quarter, but it's just one annual fee. Is that essentially for plans that, like you said, have HRA, HSAs attached to it?
Not HSAs, HRAs, yes. So for example, if you were a fully insured small employer or large employer that had an HRA attached to the plan, PCORI fees would be in play.
Got you. All right, that answered that question. And then the other question I had was on the level funded plan.
Sure.
You're talking about the surplus. So say Cigna, you I don't know, you get, so let's just put a number out there, $15,000 of, you get a check from them for $15,000 because of the surplus.
Sure.
What were you were saying does that go back into the pot, or you're saying that gets dispersed? I was a little unclear with that.
So with Cigna, how they return that surplus, there's a credit to your actual invoice. I believe they may give you an option to actually cut you a check, but in most cases, it's a credit to the invoice. We had a question come up in the chat before too, where we were talking about the surplus becoming a plan asset. If you do pay 100% of the premiums, it gets a little muddy here. I would advise reaching out to outside counsel, because that still can be considered a plan asset and you have to use it for the betterment of the plan, meaning your employees. On BEB, when you're cut that physical check, let's say, for example, you're paying 90% of all the premiums for all tiers, single, family, employee, spouse, then that 10% of those premiums the employees have been being paid, that becomes the actual plan asset, and you have to use that towards the betterment of the plan. But again, I always say, please seek outside counsel on specifics regarding this plan asset. We're just giving you kind of a high level overview of what you can and can't use that for, because in the past, it's been considered that you can just use that as at your discretion, which you cannot.
So you're saying it should technically, so essentially should be used toward whatever plan you plan on doing, maybe like the following year, put toward it. So maybe it knocks down their premiums or something.
Sure. Yeah, you can use
Okay.
it for a premium holiday. That's what I meant by that. Just not for
Okay.
a month, two, depending on how much that surplus is, or you can use that to purchase another benefit. And when I say betterment of the plan, it's not necessarily having to be that medical plan. You could purchase another benefit with that surplus.
Gotcha. All right, thank you.
So I got a question here. It says clarify the major differences between level funded to a self-funded plan. Sure, with the level funded plan, like the example I gave before, kind of being that hybrid model. With a level funded plan, you're going to have the benefit of paying set premiums every single month. You'll also have the ability to see how your claims are running, but you won't get into specifics if you're a small employer as you would with a self-funded plan, getting high, large claimants, seeing who's paying what, like Susan alluded to before. With a self-funded plan, you'll see that fluctuation monthly of high-level claimants. You'll get specifics on high-level claimants where you won't with a level-funded plan. With a level-funded plan, like I said before, you'll also have the ability to get a surplus depending on how your claims are running.
Right. So
So-
a level funded plan would be more predictable. You'll know how much you need to pay every month, as opposed to a pure self-funded plan. You don't know month to month what claims are going to come in that you're going to need to pay.
Exactly.
Any
So,
other? Go ahead.
so just so the level funded plan, so if we have a premium of X amount, like say $5,500 a month, and it doesn't change unless someone's added to it, that's considered a level funded plan?
Yeah, level funded plan is going to mirror
Okay.
a fully insured plan. When your rates, let's just say your rates for a single is $1, for employee spouse, it's $3, employee child, it's $2, families, $4. Those rates will not change monthly. When your renewal comes around, obviously you'll see what your claims have been the past 12 months. If they're sent out quarterly, you'll see that as well. And then based on, depending on what platform you're in, be it BEB or Cigna, based on how your claims have run that past 12 months and how the captive alone has run as well, you'll see your increase based on that experience.
Gotcha, thank you.
Or decrease. I wish I could say it was a decrease.
Right.
Yeah.
We don't see much of that.
Yeah, I know. I wish we did.
Yeah. Do we have any other questions? Because this pretty much wraps it up.
Do we get copies of all this slideshow?
Yes, you'll get copies of the slides and you'll also get a link to the recording.
Okay, thank you.
You're welcome.
Welcome.
Any other questions from anybody out there? Okay, I think this will do it then. Jeff, there was nothing else in the chat?
Nope, I think we got everything here.
Okay.
Yep.
All right, good. Thank you, everybody. Again, if you have any additional questions, feel free to reach out to your account executive. They would be happy to help you out. And thanks for coming. We'll see everybody soon.
Thanks, everybody.
Okay, bye.
Thank you.